Can you hear me well? Yeah, I guess so, right? Super. So, talk will be in English, but feel free to ask questions in German if you want. Hope I can answer them. I'm going to speak about the current situation of the SaaS funding markets. It's probably a topic that you have been hearing a lot about lately. So I'll try to be as fact-based and data-driven as possible, give you sort of the data, what's the market saying, and then also give you my view on what can you expect in case you guys are fundraising right now. So I don't see very well how many people is there, but can you please raise your hands if you are an investor, a VC investor? Okay, 3, 4, good. And raise your hand if you are a founder who is either raising or will be raising soon. Okay, good. So hopefully I have some insights for both groups. So let's start with what the public markets are saying, right? So here you see a group of SaaS companies gathered by Bessemer, which is basically sort of what they call the cloud index. Those are mostly SaaS companies. Some companies are not purely SaaS. There is PayPal, there is Square in there, but most of it is SaaS. So we can take it for a good proxy of what the public SaaS markets are doing. We see that sort of on the y-axis you see the revenue multiples, and on the x-axis you see the time, and you see basically that the multiples had been flat for a while. And then sometime around end of 2018, they started growing. And so we reached a peak in basically September 2021. The 3 lines that you see here are the median valuation, the lowest quartile, and the top quartile. So the first thing that we can see here is that the 3 groups have been equally affected. So it's not that the market is penalizing expensive companies rather than cheap companies. It's just the same basically across the board. What we will see later is that the market is actually penalizing non-profitable companies versus profitable companies, which is a different thing, right? So currently we are at, let me see if it works, 8.4 times revenue. That's last 12-month revenue. It's not ARR, so there's a small adjustment there. About 8.4 times revenue multiple being paid as a median valuation for SaaS companies in the public markets, right? And that's down 54% from the peak of 18.4. The good message is we are at the same level of 2018, right? The bad news is that it could go down further, so we don't know exactly how it's gonna evolve. So let's check how we get there. How we get there? That's a zoom in of 1 year, so last 12 months. The 3 lines again, and you see that basically at the peak, US inflation data came out. There had been a trend of about 5% flat inflation data for 3 quarters, and then all of a sudden it jumped. The market started projecting higher inflation, then higher interest rates, and so on and so forth. Also, then we saw a number of earning releases of the COVID darlings. So there's a group of companies that have been very much favored by the COVID situation, grew very fast, and basically Q3 or end of last year, they had very tough comparisons year on year, right? So their growth rates basically came down dramatically as a result of they have to compare now to Q3 2020, right, which was at the peak of the COVID demand, right? And then we saw again full year earnings for all those companies: Wix, Shopify, Zoom, DocuSign, and then of course the invasion of Ukraine, and those sort of all together created some sort of a perfect storm that basically drove the markets dramatically down. What happens in the end is that all those valuations are mostly done using discounted cash flow models, which is what the analysts use. If you guys have ever played around with a discounted cash flow model, there are 2 inputs that are super critical for the outcome, which is the interest rate or discount rate at which you discount the future cash flows, and then the projected growth, right? And both things have been significantly affected. And sort of that's the result that we see then in the markets. Okay, but if we look at actually the group of companies that is profitable versus non-profitable, there we see a big difference, right? So that's a different set of companies, slightly different because it's been done by Stifel, which is sort of, it's very similar group, but it's not exactly the same, just to be clear. But here they've divided the group between profitable and unprofitable, right? And you see that the group of unprofitable SaaS companies have been significantly down, about 50%, whereas the group of profitable companies has been slightly affected, but sort of stays pretty much stable, right? So what the market is telling us is unprofitable is not sexy anymore, and that doesn't mean that growth is not important. So that's another message, which is that companies that grow very fast are still more valuable than companies that do not grow that fast, right? It's just that the market wants profitability and growth at the same time. So here you see again a breakdown of the same group of companies divided by 4 groups. Groups that grow more than 30% revenues year on year, 20 to 30, 10 to 20, and 10. And you see clearly that the group of companies that grows faster is clearly also more valuable, about 3 times more valuable than the group with the lowest growth, right? So currently the group of companies that grow more than 30% is about 15 times next 12-month revenues, which is closer to the ARR number that we sometimes use in VC, right? So basically 2 things are happening. The market values profitable companies better, higher, but they still look for growth. And if we look at the companies on the first group, on the Bessemer index, and we rank them by multiple, those are the first 20, right? And you can see here that the top 5 have a very good combination of growth and profitability, with one exception, which is Sentinel-1, which I'll talk later about what I think that, or why I think that this company is there. So if you look at the number 1, Snowflake, 102% year-on-year growth, 5% adjusted profit margin, that means excluding stock-based compensation, and 178% net revenue retention. So phenomenal numbers that deserve 26 times revenue multiple, which I think it's a good premium for such a good company, right? And then you look at the rest, very, very similar. The only one that is not profitable is Sentinel-1. My feeling is that Sentinel-1 is here because the same reason that CrowdStrike and Zscaler are here. Those are cybersecurity companies, which is the sector that has been less affected by the Ukraine war, basically. So the sector that's been actually even favored as a result of the war in Ukraine. Okay, so let's take a look at what. Let's see if I can move it. Yeah. So let's take a look at what is going on in the private markets, right? So probably most of you know that VC markets work like a chain. VCs are usually specialized in 1 or 2 stages of this chain, right? And VCs look at the next stage or 2 stages ahead to figure out what are the prices that are being paid on those stages. And then we do reverse engineering and we figure out what is the price that we should be paying right now for our stage, right? So we always look at the other stages. What are the other guys doing to figure out what we should be doing, right? And then it works like a chain. And of course, if we see that the public markets decreased by 50%, we have to assume that this will have an impact on the other stages. Basically, time reversed. So first Series C will be affected, then Series B, then Series A, and then Series C, which is what we're seeing right now in the market. Also, there is a certain dampening of the effects, if you will. So the correction in the public market doesn't have to be the same correction that we see in the Series C, which also doesn't have to be the same correction that we see in the Series B, and so on and so on. So to me now the question is, I'm basically specialized on seed, right? So to me the big question is, how much will the seed rounds be affected? and if they will be affected, because we don't see this yet in the data, right? And I'll come to that in a moment. Okay, so now let's look at what's going on in the private markets. Here you see the Series B valuations on the sort of from Angel List, so on the companies in the platform of Angel List. In a time series, January, February, March, April, post-money valuation on the y-axis, and then on the x-axis you see the different percentile groups of valuation. And what we can see here is that the most expensive part of the Series B has been affected and is also very volatile. I assume this is probably, a statistical artifact out of the fact that there are not many companies in that group. But you see basically a decrease across the board down to the median valuations of Series B, right? Series A, similar, but only on the high end. So you see here valuations coming down on the Series A on the top 5%. On the top 5%, top 10% as well. Highest quartile as well, but then the median has stayed basically flat. So there's no big change in valuations on Series A in the median at the moment. And if we look at pre-seed and seed, pre-seed hasn't even noticed anything. No, the world keeps growing. I guess there will have to be some effect at some point, but we don't see it yet. And in the seed valuations, you see also in the most expensive part of the market, valuations have been coming down, but still the median is unchanged, right? So I guess what we're seeing here is that there is an effect from public markets going down to earlier stages. These effects are time delayed and not 100% the same correction on each of the stages. And again, the question is what will happen with the seed valuations in a few months, right? That's the global funding in venture-backed companies since 2020 on a monthly basis. Data from Crunchbase. You see that the peak of funding was reached in November 2021. And since then, the funding has been steadily coming down. Hard to know how far down it will go. I think that there are some reasons to believe that it will continue to go down. But what I don't expect is a massive shift in sort of this gets cut by half or something like that. I don't think that it is going to happen. One of the reasons why this happens as well is because if you have half the valuation, you can only raise half the money, basically, right? So dilution usually stays the same, around 20%. But if you are going to be investing at half the valuation, then the round has to be half the size. Otherwise, you over dilute the founding team. Okay, so now we've seen the data. Let's go now to what I think that we can expect if we go fundraise in this current environment. So the first thing is that some VCs are definitely pausing or sort of freezing. That depends mostly on their past behavior. So what have they done to date? What has been their investment strategy? To see how far are they right now from what the market is saying. And until they figure out how to adapt, they will probably freeze. They will probably not invest. The vast majority, though, at least from my conversations with other VCs, is that we are still investing. We try to keep the same pace. Actually, if anything, it's a good time to invest right now. The problem is that everyone is now super busy. First, we are super busy with our current portfolio because some companies are fundraising right now, so we need to figure out how to solve this. Other companies are redoing their business plans, so it takes a lot of time as well. And on the other hand, at least me, and I guess also some of my peers in the room can confirm that, we are now receiving much more inbound deal flow than what we received in the past. So I have received more, inbound opportunities to look at in the last 2 months than probably what I received in the last 12 months, right? So that keeps me also super busy as well, right? So it's not that some VCs do not want to invest, but probably sort of the amount of time that each of us has to deal with the things that we have to do, it's limited, and so probably that makes also a difference, right? Overall, I expect lower availability of capital in general. Some VCs will be setting more reserves for their existing portfolio, so that they are probably right now redoing their fund models. So the calculation that they use to know how much reserves should they have for the existing portfolio companies versus how much should they allocate to new investments. That will probably reduce the availability of capital. And then, of course, lower valuations have to lead to lower round sizes. It has to be like this. I think due diligence is back again, a trend. So there's been a period of time where sort of VCs have cut corners because there was a lot of competitive pressure, also some pressure from the team saying, look, guys, we need to do a term sheet by next week, and sort of VCs try to adapt the best we can. But I think that's probably over. So if you are fundraising now, expect thorough due diligence and expect that the VCs will take the time they need to sort of really understand the business, which I think is good. I think that's sort of part of the cleaning that is going on in the market. That is a good thing. Capital efficiency is more important, meaning VCs will be asking questions about your unit economics, probably much more than the questions they asked in the past. And I'll talk about this a little bit later. It's one of our ethos at Nauta, so I think it's something that should have never gone away, but it certainly did for a while, and now it's there again. And I think investors will expect you to have longer runways and better unit economics than they expected in the past. Right. So just to finalize, and then I hope we have some time for questions and debate. If you guys are not fundraising right now, but you would like to improve your capital efficiency, those are some measures that will help you. This is not something that will save you in the next months, but certainly over time it will improve your business. I think we've heard in the previous talk about net revenue retention, about upsell. I think that's probably the number one thing that a SaaS company has to do well. And we see it also in the public markets. The top 5 companies have extremely good net revenue retentions, right? So think about this very carefully. It's always something that you can improve. It's not something that is given by your product or given by your industry. You can always work on this. And so I always suggest the companies to work on that. A few ideas. Do some customer clustering. So cluster your customers depending on how they behave in the cohorts. Work on activating the customers properly, because activation is the number one reason that prevents churn. Manual onboarding works, by the way. We've heard about product-led growth companies. There is this belief that product-led growth companies should not have touch points with the customers, at least not in person. I think that's not always correct. So manually onboarding customers is actually good. You can see the difference in the cohorts of onboarded versus non-onboarded customers. They behave completely differently. Customer health course to know which customers have higher risk of churning is very helpful. And then finally, think about your upselling as an operations, as a separate department of your business that needs to be managed as such. Meaning create a pipeline of upsells and renewals that is separate from your standard new business pipeline. Track the sort of evolution of this pipeline and create incentives to your customer success managers to actually sell. Those are the guys that are very close to the customers and they can actually sell. Okay, that's sort of regarding the net revenue retention. You can always try to optimize your cash inflows, yearly payments, is a standard. You should be able to get it if you are mid-market or higher. So mid-market or enterprise should always be able to get yearly payments. You can also get multi-year payments if you work on that. On average, some of our portfolio companies have 15 months of prepaid contracts. Nobody pays you 15 months, but some companies pay you 12, some 24, and then on average you get 15 months prepaid, which is very healthy for your business. And then improve your order-to-cash processes to make sure that your enterprise customers usually are the guys that take longer to pay, that they pay on time. And then finally, non-dilutive funding is super, super important. You just need to focus on that when you don't need the money. Because when you need the money, the bank will not be there to help you. You just need to do it before, like 12 months in advance. Start building your relationship with the banks, talk to the venture debt providers. There is a bunch of revenue-based financing options at the moment that is also, I think, very healthy. And in the end, the right mix of equity funding and non-dilutive funding for your startup is what makes the difference, right? Yeah, so that's it. Thanks for your attention. Those are some resources that you can read that go beyond the, run for the hills, RIP good times, and sort of plan for the worst. Those are a bit more nuanced things that I think can help SaaS startups to figure out what's going on right now in the market. And also, very happy to take your questions if you have.
How much discount do you suggest to give for a yearly prepaying in comparison to the regular monthly paying?
Optically, 10%. But what you do is that you increase your monthly prices.
Hi, thanks a lot, Guilhem. And I have a question regarding, so from a founder's perspective, let's say if a startup is running out of cash, let's say their runway is just until a couple of months in, would you advise them to raise a convertible note round now with sort of like a cap on the sensible valuation in the next equity round? Or would you rather advise them to go for an equity round, which means that their valuation would probably be hammered by the lead investors at this point?
I mean, obviously, it depends on your options. If you have only 2 months of runway, probably convertible note is better because otherwise equity will probably not be on time. So, but if you have a bit more runway and then you can choose between equity and convertible note, usually the dilution that ends up happening at the end of the conversion of the note is lower than if you had raised that money as an equity round. So it's better for the founders to raise convertible notes in general. But it's less attractive for the VCs. So it has to match. So you have to find VCs that are interested in doing that. But if you can get it, I would suggest you to do it. I think that's it, no? Super. Thank you, guys.